If you raise money in the United States, you must know about the Investment Company Act. The Investment Company Act is a series of rules that regulate registered investment advisors, a type of company that basically helps investors make more money. So the main idea is most people, when they talk about raising money in the United States, a lot of people focus on the Securities Act, which is obviously super important. And the Securities Act is really big on regulating types of activities when it comes to selling deals to investors. And either you're selling deals to investors as a registered person or entity with FINRA in the United States, or you're using an exemption, which is a rule that allows you to carry out that activity without registration. So either you're registered and you're doing it, or you're using an exemption and you're doing it through an exemption. So the most common exemptions with the Securities Act, we've talked about those in other videos, and if you haven't seen them, you may want to click around on the channel to get back up to date. But when it comes to Investment Company Act, these are more rules that are more focused on the types of activities as a registered investment advisor. So if you have a fund basically, and you want to help people raise money, or you want to create a fund and launch a fund, especially in real estate or in business acquisitions, it's really key to look at the types of funds that are out there and how you can make the most out of it. So when it comes to this one, the Investment Company Act says that, either you manage a fund as a registered investment advisor, or you use an exemption from registering as a registered investment advisor. And so the exemptions, you have the 3C1, the 3C5, and the 3C7. And so it's just the panel just opened up on the screen there. And these are really common exemptions. So the 3C1 Investment Company Act exemption from registering just means that, hey, you can use a rule called the 3C1 to create a fund without needing to register as a registered investment advisor. And so this rule says that you can have 99 investors max into the fund. You're not allowed to do an initial public offering, and you're not allowed to charge performance fees to accredited investors. So this is at the time of the recording of this video. So a performance fee is just a fee that is a percent of, it's basically a fee that is related to how much money you make. Let's say you make an investor a certain amount of profits on their money, you charge them 20% of the profits you make for them. That's a performance fee. And then the other type of fee is usually the management fee, which is a fee based on how much money they put in. So accredited investors are usually there are only two types of investors people talk about. They're accredited investors who have over $1 million in assets outside of their personal home, or somebody who makes $200,000 per year. So those are usually what people call accredited investors. But there are actually levels that are above this. And in the United States, you have a qualified client and a qualified purchaser. So not to be confused with a qualified investor, which some people mistakenly call an accredited investor. So let's not get confused. So basically, the qualified client is somebody that has over $1 million in assets with a registered investment advisor, but their net worth is above $2.1 million. A qualified purchaser is a person with over $5 million in investments. So the main idea is these are people that are richer than accredited investors, and people can only charge performance fees to these types of investors for this type of exemption if you want to create a fund in the United States using this exemption. You're using this rule. So that's the first one. So basically, it's the small fund this is the small fund exemption basically, for lack of better words. The 3C5 is super common, and that one is the next one we'll talk about. It mostly has to do with real estate. So if you want to create a real estate fund, this is the one that everybody does. So 55% of the deals that you acquire, if you're doing one deal at a time, it's basically 100% of the deals, so you're good. If you're doing multiple deals, you want to have slightly more real estate. But then 55% of the deals that you get involved with in a fund using this rule has to be towards something called qualified interest, which is basically real estate. And so the other 25% of that should be real estate related. And then the other 20% can be quote unquote other. So 55% real estate directly, 25% real estate related, whatever that means. And you may want to get a lawyer because it sounds like a really gray area. And the other 20% can be anything other than real estate. So I really recommend this just to be real estate. And then the last one, and there's no limits on how many people you can bring in, because the 506D regulation, I guess regulation D 506C rather, 506C says that you can raise money from an unlimited amount of investors. So if you combine both these exemptions, then you can raise money from an unlimited amount of investors. And usually the thing that prevents you from following that 506C rule, which is a rule I don't want to get, so if you don't know what it is, just click around in the channel. But basically it's an exemption from registering with FINRA. So if you follow that rule says that you can invest in an unlimited amount, you can find an unlimited amount of, you can raise an unlimited amount of capital with unlimited amount of investors. So it's these rules that seem to limit the amount of investors that you get if you do a fund. So anyway, moving on, 3C7, they must be qualified purchasers or above, and you can do under, it must be under 2,000 investors, so 1,999 investors max. And you can basically charge anything, performance fees, and it can be any type of asset, but they must be qualified purchasers or above only. So this is basically the big boy fund. So you have the little boy fund, the real estate fund in the middle, and then you have the big boy fund, which is for qualified purchasers, the biggest type of investor or above. So, I mean, that's pretty much a quick overlay. And all this gets submitted to something called the Form D. And I'll try to dig into Form D, but basically the main idea is, so essentially, after investors invest in your deal, you have to submit something called the Form D to EDGAR, to the SEC. EDGAR is the filing system that the SEC uses. The SEC uses the Securities and Exchange Commission, which regulates everything here. So right here, most people do 506C. And these are the Investment Company Act exemptions people can choose. So if somebody wanted to do the real estate fund, basically, then they can choose this one. And many people never talk about the Section 3C4 and the 3C2 and the other ones. Perhaps we'll make videos and address them. But the one that 99% of people talk about is usually these three. And the last point is, if you want to raise money, but your deal isn't in real estate, how can you make real estate, how can you charge accredited investors performance fees? That's a question that we start to get a lot of. So one thing that you can do is, if you have a fund where you're buying a business, make sure that if the business is attached to real estate, then you may be able to just use the 3C5 if you're able to create a strong argument that more than 80% of the fund is attached to real estate. So you can have one part of the fund, you can create something called parallel funds, where one part of the fund is only for that real estate part of it, and then the other part is for the business part of it, where you're just targeting qualified purchasers and above. So that's one way of doing it, right? Another way of doing it is making sure that the accredited investors invest through a different situation where they may be called a qualified purchaser. So sometimes if they work with the right RIA, perhaps they may be able to invest that way. And then that's something to talk about with securities lawyers and so on. And so the last thing you can look at is just targeting accredited investors for your real estate part of the deal, and making sure that the management fee is aligned with the profit of the deal. And you can make sure that the people that are qualified purchasers can partake into the non-real estate side of the deal. And so that's just some ways you can do it, but just make sure that you just recognize this rule. And the next step is, when you're raising money to acquire businesses and so on, this can apply for one deal at a time or multiple deals at a time. So with this, don't be overwhelmed or anything, but if you have any questions about any of this, just make sure you head to raises.com or click around the channel if you want to learn more. And so we'll see you then.